Is the housing market in New Zealand really crashing? Today, we're taking a closer look at the New Zealand housing market, which has been going through some significant shifts recently. These developments may also offer valuable insight into broader trends shaping the global economy. We'll examine what's driving these changes, how they're affecting businesses and households, and what they could mean for other developed economies such as Australia and Canada. So, let's get started. New Zealand's housing market has attracted a great deal of attention lately due to the sharp decline in property prices. This doesn't appear to be a short-term dip. Rather, it looks more like the beginning of a substantial market correction. A key player in this story is the Reserve Bank of New Zealand, or RBNZ. While the central bank recently decided to keep the official cash rate unchanged at 5.5%, its commentary and forward guidance remain highly informative. In its monetary policy statement from August 2023, the RBNZ indicated that it expects the New Zealand economy to contract in the second half of 2023. This downturn is being driven by slower economic growth and the ongoing impact of high interest rates, which continue to weigh heavily on domestic demand. Renters and mortgage holders are among those feeling the pressure most acutely. The rapid rise in mortgage rates has significantly increased repayment burdens for households, reducing disposable income and, in turn, dampening consumer spending across the economy. Importantly, the full impact of these rate hikes has yet to be fully felt. Many borrowers are still rolling off lower fixed-rate loans onto much higher rates. Over the coming months, this transition is likely to erode household savings that have so far helped cushion the blow of higher repayments. Household spending is also being constrained by falling home values. As property prices decline, homeowners experience a negative wealth effect, making them less inclined to borrow or spend. Heightened financial uncertainty tends to make people more cautious, which can have a broader knock-on effect for the business sector. Before we continue, take a moment to subscribe to the channel if you're finding this analysis useful. Now, this is where things become particularly interesting. Like Australia and Canada, New Zealand has experienced a surge in population growth driven by strong net migration. In fact, the country is on track to record its highest annual net migration figures in a century. While this may initially appear positive for economic activity, it also masks a deeper issue. When population growth outpaces economic performance, economic output per person slows. This can leave individuals feeling worse off, even if headline growth figures appear solid. One of the most critical elements of the RBNZ's statement is its outlook for interest rates. Back in May, the central bank suggested that rates might ease sooner than expected. However, its most recent guidance points to a more restrictive path. According to the Monetary Policy Review, there is now roughly a 40% chance that interest rates could rise again. Current projections suggest the official cash rate may not fall below 5.5% until 2025, which is a long time given the current economic headwinds. Only weeks ago, Reserve Bank Governor Adrian Orr spoke with Bloomberg, offering further clarity on the RBNZ's stance. He emphasised the importance of maintaining the cash rate at 5.5% to keep inflation under control and preserve economic stability. His comments suggest a cautious approach, prioritising stability over abrupt policy shifts. Global conditions also play a crucial role in shaping these decisions. Central banks worldwide remain concerned about inflation, which is still proving stubborn despite headline figures easing. The gap between headline inflation and underlying or core inflation is a global phenomenon and may signal that the next policy move could involve further tightening rather than rate cuts. The RBNZ's decision to keep rates higher for longer aligns closely with the approach taken by many other central banks. Over the past 15 years, ultra-low interest rates across developed economies have encouraged high levels of borrowing, particularly in the property market. These conditions inflated house prices and led many households and investors to assume cheap money would persist indefinitely. If interest rates remain elevated for an extended period, that assumption may be challenged. Highly leveraged and speculative investments could come under pressure, potentially triggering a more pronounced decline in property prices. Homeowners carrying substantial debt may struggle to adapt to higher repayments, increasing the likelihood of forced property sales. Other developed economies can learn a great deal from New Zealand's experience with rising interest rates. Compared with the rest of the world, New Zealand was one of the first countries to tighten monetary policy. Its interest rates were among the earliest to push above 5%, sending a clear signal that policymakers were serious about bringing inflation under control. This proactive approach sets New Zealand apart and highlights the importance of timely economic decision-making. The outcomes of these policies are likely to offer valuable lessons for other countries facing similar challenges. There is also a strong connection between the housing market and the share market. Falling property prices don't just affect homeowners, they can also weigh on equity markets. Since early 2022, New Zealand's share market has struggled to gain momentum. While there have been brief attempts at recovery, the market has yet to return to pre-pandemic levels. This lack of progress raises concerns about overall business confidence. If share prices continue to weaken, investor sentiment may deteriorate further and spill over into the property market. When both markets decline at the same time, households are more likely to prioritise protecting their savings rather than spending. As consumer spending slows, company profits can come under pressure. In response, businesses may cut costs, including reducing staff numbers, which can lead to rising unemployment. This can trigger a chain reaction as economic conditions deteriorate. If both the housing and share markets fall, reduced household spending can hurt business revenues and push unemployment higher. As job losses increase, highly indebted households may find themselves under significant financial strain and could be forced to sell their homes. If many forced sales occur at once, the housing market could experience a sharp downturn. The likelihood of such a scenario depends heavily on both domestic conditions and the global economic environment. A global economic slowdown would significantly increase the risk of a severe correction in New Zealand's housing market. This raises an important question about what lies ahead for property prices. Looking at long-term trends, New Zealand house prices have clearly moved lower. In November 2021, the median house price peaked at around $925,000. By January 2023, it had fallen to approximately $762,000. While prices have stabilised somewhat in recent months, closer inspection shows a modest decline between June and July. By comparison, Australia's average house prices have fallen by roughly 10%, whereas New Zealand has experienced a much deeper correction. This difference reflects the unique conditions in each market. Australia has seen unusually low housing listings, a less aggressive interest rate tightening cycle from the Reserve Bank of Australia, and exceptionally strong population growth driven by migration. New Zealand's housing market, by contrast, may offer a clearer picture of underlying market conditions. During the pandemic, an unprecedented mix of government stimulus, policy intervention, and ultra-low interest rates artificially inflated house prices. As these supports are withdrawn, prices are under pressure to adjust downward. There remains considerable uncertainty about whether the New Zealand housing market will stabilise or continue to decline. Many factors will shape the outlook, but interest rates remain the most critical. If rates stay higher for longer, the risk of rising unemployment increases. So far, forced sales due to job losses have been limited. However, if unemployment were to rise sharply, a large number of properties could come onto the market. With increased listings and weakening buyer confidence, the housing market could experience a significant downturn. The probability of this outcome depends on both New Zealand's economic resilience and global economic conditions. A worldwide slowdown could tip the balance towards a major housing correction. In summary, New Zealand's housing market represents a compelling case study with implications well beyond its borders. The Reserve Bank of New Zealand's decision to keep interest rates elevated for longer may shape the country's economic outlook and influence policy thinking in other developed economies. Balancing inflation control with economic stability remains a difficult challenge for central banks globally. As a result, New Zealand's housing market will be closely watched as a potential indicator of broader economic conditions. Feel free to share your thoughts in the comments, and don't forget to check out the other videos on your screen for related analysis.